Welcome everyone. Today we are diving into a pivotal shift in the housing market. Fannie Mae has officially updated its condominium financing guidelines, marking the most significant regulatory change we have seen in years. These updates, effective as of March 2026, fundamentally alter how condos are reviewed, approved, and insured, impacting everyone from lenders to agents. As a quick reminder, this video has a written presentation to follow along. Don't forget to download a copy from my training website, so you can print it, follow along, study it, and make notes. The link to the training website to download this presentation is on the screen and in the video description. And if you enjoyed this training, be sure to subscribe, like, and comment. To understand the scope of these changes, we must look at the four major shifts occurring across the lending pipeline. We are seeing the total elimination of limited reviews, a strategic expansion of review waivers, much tighter reserve requirements starting next year, and revised insurance rules that address modern market volatility. These pillars redefine condo eligibility. Let's begin by discussing the most disruptive change, the total overhaul of project reviews. For years, many transactions relied on a specific shortcut that has now been retired. Understanding the new two-path framework is essential for every real estate professional, as it determines how quickly, or if, a transaction can move toward a successful closing. The era of the limited review is over. Previously, this pathway handled nearly 40% of all condo loan approvals. As of March 18, 2026, it is gone. Lenders are left with two options: a comprehensive full review requiring deep financial documentation, or an expedited waiver for qualifying projects. Unorganized associations will now face much longer timelines. To balance the loss of limited reviews, Fannie Mae has expanded the waiver of project review. This is great news for boutique buildings with 10 or fewer units, which can now bypass full reviews entirely. This simplified path shortens approval timelines from weeks to days, offering a strategic advantage for those working with small urban or townhome-style communities. In a significant policy reversal, investor concentration limits have been removed. The old 50% cap on investor-owned units is history. This means buildings in vacation areas or rental-heavy towers that were previously ineligible for conventional financing are now open for business. Lenders no longer need to certify owner-occupancy ratios, providing buyers with far more financing options. For those of you working in the Florida market, there is a specific victory to celebrate. The Mandatory Project Eligibility Review Service, or PERS, for new attached condos has been retired. This removes a lengthy, weeks-long administrative hurdle. New construction in Florida now follows the same standard framework as the rest of the country, streamlining the entire development process. Next, we must address financial health. Underfunded reserves are a leading cause of project ineligibility and sudden special assessments. Fannie Mae's updated standards for reserves are significantly stricter. We are looking at a two-phase implementation that forces associations to prioritize long-term fiscal stability over short-term budget savings to remain eligible for mortgage backing. Starting in August 2026, reserve study requirements will become much more stringent. These are no longer optional suggestions. Associations must now follow the highest recommended funding level provided in their studies. Furthermore, they are prohibited from depleting reserve accounts to zero for routine maintenance, and studies must be updated every 3 years to remain valid for exceptions. The most significant financial shift happens in early 2027, when the minimum reserve contribution floor rises from 10% to 15% of annual income. This 50% increase means many associations must revise their budgets now. Failure to meet this 15% threshold by the deadline could disqualify every potential loan within that entire community. Managing these changes requires careful timing. We have 3 critical dates to track: March 2026 for review process changes, August 2026 for the new reserve study rules, and January 2027 for the increased funding floor. Tracking these separate effective dates is vital for HOA managers and lenders to avoid accidental disruptions in their loan pipelines. Now let's turn to insurance. Fannie Mae's updates reflect the realities of today's volatile property insurance market, especially in high-risk regions. These changes affect master policies, deductibles, and the specific requirements for unit owner coverage. The goal is to balance the rising cost of insurance with the necessity of maintaining adequate protection for the collateral. we are seeing three key adjustments to master policies. First, inflation guard coverage is no longer mandatory, which helps reduce premium costs. Second, while roofs must be insured, they no longer require full replacement cost coverage in all markets. Finally, starting July 2026, a $50,000 per unit deductible cap will be enforced to protect individual owners. The role of the HO6 unit owner policy has shifted from recommended to required in several scenarios. If the master policy doesn't cover interior improvements, or if a per-unit deductible applies, the lender must verify individual coverage. Additionally, these policies must have specific deductible limits, either $2,500 or 5% of the total coverage amount. To help you advise your clients, remember this quick reference. Inflation guard is out. Roof coverage requirements are more flexible. Per-unit deductibles are now capped at $50,000. And most importantly, HO6 policies are now a mandatory requirement whenever the master policy leaves a gap in interior coverage or carries a per-unit deductible. You might wonder why Fannie Mae is implementing these changes now. The agency has explicitly identified systemic risks that drove these updates. By understanding the why behind these regulations, lenders and HOA professionals can better navigate the new landscape and explain the necessity of these higher standards to their boards and clients. Several forces are at work here. Rising insurance premiums in coastal states, the financial fallout from recent building collapses, and systemic underfunding of reserves have all increased the risk of loan defaults. Fannie Mae's goal is to ensure long-term financial sustainability. These tighter standards reduce exposure to deteriorating assets while streamlining the path for lower-risk, well-managed projects. These are not just abstract rules. They have direct practical implications for your daily work. Whether you are listing a property, financing a deal, or managing a community, these updates change the way you must operate. Success in the 2026 market depends on how quickly you adapt your workflow to these new regulatory realities. Your listing and pre-qualification strategies must evolve. Because limited reviews are gone, you need upfront due diligence to prevent deals from failing late in the process. Request HOA documents before listing. Assess reserve funding levels immediately to see if they hit the 15% mark, and identify the review path early to set realistic expectations for your buyers. There is good news amidst these changes. Removing investor limits opens up previously cash-only buildings to a whole new pool of conventional buyers, potentially driving price appreciation. Furthermore, the simplified path for small projects under 10 units makes boutique condos much more competitive with single-family homes, thanks to shorter approval timelines and reduced paperwork burdens. For HOA managers, the clock is ticking. You should audit your reserve studies now to ensure they are current and compliant. Review your master policies to prepare for the upcoming deductible caps, and plan your 2027 budgets to meet the new funding thresholds. Keeping an organized, ready-to-go document package is the best way to maintain your community's financeability. Lenders and underwriters must also adapt. Internal checklists need to be updated to remove the limited review option and reflect the new full review versus waiver logic. It is also critical to verify insurance deductibles at the very beginning of the process. Communicating these changes to your referral partners now will prevent deal-killing surprises later in the year. When a full review is required, documentation is key. You will need a current budget, a recent balance sheet, a valid reserve study, and comprehensive insurance declarations. While owner occupancy is no longer a hard limit for eligibility, tracking project data like delinquency rates and commercial space remains a standard part of evaluating the overall health of the project. To keep everything straight, use this compliance timeline. March 2026 brought the review and investor changes. July 2026 introduces the deductible caps and HO6 requirements. August 2026 triggers the enhanced reserve study rules. Finally, January 2027 marks the rise to the 15% reserve contribution minimum. Marking these dates now will keep your team ahead of the curve. Before we end, and as a final reminder, this video has a written presentation to follow along. Don't forget to download a copy from my training website so you can print it, follow along, study it, and make notes. The link to the training website is on the screen and in the video description. And if you enjoyed this training, Be sure to subscribe, like, and share. In summary, these changes represent a new era for condo financing. By updating your workflows, tracking these critical deadlines, and educating your network, you can turn these regulatory shifts into a competitive advantage. Those who move quickly to master these guidelines will serve their clients with greater confidence and close more deals in this changing market.